Hi there, and welcome to this week's edition of Maqro Minutes. It is the 7th of May, Friday. I'm your head of training, Mark Gardner, and let's go through the formalities as per usual. The information which is summarised in this webinar does not constitute financial or other professional advice. It is general in nature, and it does not take into account your specific circumstances and should not be acted upon without the full understanding of your current situation and future financial goals and objectives. Okay, we'll start off with stocks in our universe. We're going to have a look at Westpac, Raise and CBA. We're going to start with Westpac. So we've had three of the big four reporting this week, ANZ, Westpac and NAB. So we'll have a look at Westpac here. They experienced mixed results, but the bank's net interest margin falling 15 basis points. Their cash earnings beat expectations by about 3%. They'll pay a dividend of about 58 cents, which represents a 4.8 yield on the previous closing share price. It goes ex-divvy on the 13th of May and it's payable on about the 25th of June. Revenue increased by 1% to 10 billion or 10,686 million, while net interest income increased by 8% compared to the second half of 2020. Westpac also enjoyed an impairment benefit of about 372 million compared to an impairment expense at the same time last year of 2.2 billion. The CET1 ratio increased by 1.2% to 12.34, keeping well above the regulatory minimums. I think the other two were at 12.4. So they're, basically all those banks are in pretty good shape. Westpac saw a 49% comparable to the previous period increase for lending at houses, but the bank expected moderate price growth of the housing prices. On the 5th of May, Westpac was charged with insider trading by ASIC. They have actually taken ASIC on before and won. And ASIC does tend to get a little bit offended by that sort of thing. So it'll be interesting to see. It's to do with the swaps department. I dare say, having worked in trading floors my whole life, they'd be highly unlikely to get any sort of conviction there. And if so, they'd probably just pin it on an individual rather than the room. Before the Westpac reporting, they were about $25. They trade up to $26.40 high, and they've closed yesterday at $26. So next one we're going to have a look at is Raise. So Raise, it's a current small caps division recommendation. Its monthly metrics released for April were extremely strong fund growth of 6.2 on the previous month. We believe this growth was strong enough to offset the slowdown in customer sign-ups and active customers, especially in Southeast Asia. Funds continuing to grow at an increasing rate, indicating that Raise's existing customers are spending more as economic activity increases. There was a small hiccup with the decelerating in customer sign-ups and active customers. They're a bit of a concern in Southeast Asia. Indonesia saw sign-ups grow by about 5.7 in April compared to 18% in March. Active customers fell from 11 to 2.2%. Malaysia was also weak, though less so than Indonesia. The monthly sign-up growth fell by 2.2%. Active customers by 1.6%. So realistically, there could just be a statistical rebalancing, really. Obviously, 18.8% growth in the previous period in March is quite considerable. You might just see those numbers just smooth out over time. The management should be taking these declines seriously, but it should be more than offset by the impending expansion to Thailand. Look, it is a bit of a thin stock. It's something that the trading department has covered for a while now. We've tended to trade around it. It's recently been up to around about 191, 192. Trading department exited a portion of the position up there. It's pulled back to about 150. There was a capital raising, which was well oversubscribed. It was an institutional capital raising at about $1.50. We re-entered there around that 150 mark. It's been trading on really thin volume and a really thin bid-offer spread. It's around the low 140s to high 140s over the last couple of days. There isn't much on the bid behind. So look, it's one of those ones that the fundamentals are strong, but you just probably need to be prepared for some pretty wild intraday price movement in the event that we see the Nasdaq fall heavily overnight. It's one of those ones realistically that you just really have to trust in the research, know that they're going in the right direction, and they're well ahead of their year-end target of getting to $1 billion in funds under management. I think they'd have to be a good 3 months ahead. So yeah, just err on the side of caution, but it could also provide a good buying opportunity if it gaps to the downside one day, because it'll likely just be on a lack of volume, and we would see that the Insto oversubscription capital raise at 150 means that there would be at least a small amount of institutional buying potentially down below that 150 mark. Rightio, we're moving on to ANZ now. They reported a strong half-year result, largely beating forecasts. Net credit provisions 491 beat forecasts by 13.9%, contributed to a statutory profit after tax of 2.9 bill, beating previous half's result by 45%. First half net interest income of 6.9 billion was in line with expectations. ANZ announced a fully franked dividend of 70 cents a share, which is a yield of 4.7, around the same mark as what Westpac was. The dividend beat expectations by 7.7%. It goes ex-divvy on the 10th of May, which I'm assuming is obviously early next week. It's payable on the 1st of July. CET1 ratio increased to 12.4, beating expectations by 3.6. Earnings per share of 105 cents per share beat expectations by 4%. They did trade a high of around about 29.20. I think they finished around 27.65 yesterday. Look, they were, the price action there realistically wasn't as good as Westpac, surprising to the upside, because I think realistically the market saw Westpac's results and probably a little bit of the buying was done the day before into the announcement of ANZ's results. So it's you can probably ignore it slightly, given that they probably had a little bit of a buffer the previous day. The financials have been going quite well in the States. Obviously, there is a very, very distinct shift out of growth into value in the US at the moment. The Dow convergence between the Dow and the Nasdaq for the last 2 days. The Dow's actually been up, hitting record highs, and the Nasdaq's been falling away. This is one thing that the trading department is extraordinarily conscious of. We're avoiding things under a market cap of $1 billion at the moment for any new recommendations. We're very much veering away from tech for the time being. But with an eye on maybe a pullback in the Nasdaq could provide some really good buying opportunities. So have a look back at your your small cap recommendations from the investing team, and look, it always pays to be prepared to take advantage of a sharp drop, because realistically, with the amount of money that's been printed over the last year, we're probably still going to be 12-month to 24-month quite bullish. We just are at a point in time at the moment where a vacuum of news, small murmurings of inflation and a reduction of QE tapering is probably going to hurt those tech names for the moment. So in terms of just de-risking your portfolio, it's that's what I've been recommending from the trading department point of view. Which even though they're generally shorter term recommendations or shorter time frames, those principles can still be applied to managing your portfolio. Rightio, stocks to watch out for. So CBA, they're expected to report on the 10th of May. They're basically following a week with the other three banks have reported. I think Macquarie's is today. their trading update is expected to be quite positive, given the other banks have been in line or beat earnings expectations. Before Westpac came out with their announcement, they were at about $90.30. They've traded up to a high of $92.94, and they pretty much closed around there yesterday as well. So the thing with CBA is it doesn't pay its dividend till August, so there's going to be no ex-divvy effect to the share price. We're generally recommending, as a firm from an investing side, trimming some of these big four banks up here. We're basically looking, a lot of the good news is very priced in. They have recovered quite well. So look, given the extent that the bull run's had over the last sort of 225, 230 odd days, and the US market looking a little bit, a little bit wary of going to any further upside. It wouldn't hurt to take some off the table up here, and really try and set up and take advantage of any potential pullback that could happen. A buying opportunity here on a 8 to 10% pullback could really set up your portfolio for the rest of the year. And being sensible and trimming out and taking some profits is one way of freeing up some cash to be able to do that. But obviously that advice is very general in nature, but that's sort of what we're thinking as a team here at the moment. We'll move on now to Grain Corp. It's expected to report its results on the 11th. Enjoyed a really positive 2021 so far. Released strong earnings guidance on the 11th, in which they targeted 150% growth in earnings in financial 2021. NPAT of 60 to 85 mil, which is a far cry from the 16 mil loss it booked in financial year 2020. Much improved earnings guidance is a result of improved cropping conditions along the east coast. After obviously 3 very weak years, bushfires, floods, drought, this year's crop was vastly improved. Product exports of 1.7 tonnes between October and 1.7 million tonnes, that is, in October 2020, and the update in February. Analysts expect a 45% roughly in growth in revenue on the previous corresponding period. EBITDA growth of 28.7 and earnings per share growth of about 64.2. They are a cyclical stock, obviously. Generally, from a long-term standpoint, you want to be selling these when they look great and buying these when they look terrible. We're probably only halfway through the cycle here. Those weather patterns, those long-term weather patterns, El Nino and El Nino, really have got probably another year, maybe 2 to run at least. We don't think this will be the last of it. They should make fairly healthy. Gains over the coming year or two. So with those favourable weather conditions, soft commodities as well. Generally, food commodities have been extraordinarily strong, along with lumber, etc. So commodities as a whole is a lot of commodity sectors are having structural shortages at the moment. I see manufacturing data and things over the last week or so are showing 42-year highs in backlogs of orders. Lumber prices pushing 2.5 times their previous record highs of $600 to $1,600. So I think coffee was up about 7% a couple of nights ago as well. So they're all performing pretty well, those soft commodities. Moving on to Xero here now. Expected to report its financial year annual report on the 13th of May. It's experienced extremely strong growth in the past year, rising 73% even after a 10% decline from early January, which was largely due to bond yields rising, which impacted tech companies in general, which is something I'll talk about after I get through this. The half-yearly update saw Xero subscribers rise 19% to 2.5 million. Revenue increased by 21%. EBITDA grew about 86%. As cloud accountancy software continues to grow in popularity. So the thematic we expect to continue in the long term. Look, I've used the software. I'm sure a lot of you have. It's brilliant. Great way to communicate with your accountant. You know, a lot of those companies, usability is very important. It's one of the reasons companies like Afterpay are leaders. They're very easy to use, very easy to sign up. You know, you would expect it pretty much just continue to get more and more ingrained in accountants, in accounting firms, communication and reconciliation with their customers. So, analysts expect the growth revenue to continue to be strong in the upcoming report. Revenue forecast to rise about 15%. Earnings per share, a growth of 376%, which is pretty awesome, and net income growth of 385 on the previous corresponding period. Look, obviously this being a very solid company, whilst it's tech, it's not really tech, I suppose. It's just a tech application to an existing financial sector. These are one of the ones that you want to be going and having a look at your charts and having a look at in the event that the Nasdaq does start to come off, which has shown some weakness. A stock like this will be unfairly sold off on the back of index selling, and you might get a great bargain in something that realistically has no fundamental direct correlation to the reason why the Nasdaq's heading down. And rising interest rates and inflation is not something that is going to hurt something that's got a relatively good PE and is very profitable and has great earnings per share growth and ratios. So look, I think it's about 133 was the 100-day moving average in that. That's probably not a bad place to have a look at it. Finished at 135 today, yesterday, sorry. It's had a high recently at 137.30. So, around those 100-day and 200-day moving averages are, usually relatively good places to have a look at a bit of a long-term interest, particularly if the stock's trending up. So, that's probably a decent example of one that to keep an eye on, and, when the rest of the world's panicking, you step in and get something cheap that you wouldn't have been able to get on, in the slow grinding higher market that we've had over the last, almost 12 months basically. So, rightio, moving on. Economic data. So we've got US unemployment rate, and what else have we got next week? Retail sales data and US CPI. So tonight we've got the ADP numbers to be released. They're expected to be around about 800,000. They haven't been the greatest leading indicator of non-farm payrolls of late. They tended to under predict what the non-farm payrolls results are. And look, and then non-farm payrolls, 10:30 on the 10:30 tonight. They're looking at around about 1 million. There is a huge range. The analysts have ranging from 700,000 to 1.2 million. It'll be obviously if there's a bit of a damn if you do, damn if you don't scenario here for the equity markets. If it's up 1.2 million, it could potentially increase the talk of wage inflation. It can and the Fed tapering their QE, which could then send bond yields higher, which will probably make the most sensitive end of the market, the Nasdaq, the growth stocks fall away a little bit. And look, if it's under disappointing economic numbers, basically they're not going to be great because they won't be thinking that the growth, the recovery is as strong as what it is. So I wouldn't expect this to be a massive driver to the upside for equity markets. We've had a lot of great numbers out of the EU this week and the UK. The UK is reaching herd immunity. So they're coming out of lockdown. There seems to be a lot of chatter about Europe and the UK outperforming the US for the time being, given that the US has possibly just already had its run. That's been reflected in a bit of a sell-off in the US dollar. So look, Europe's not a bad place to be looking at the moment, as they have bungled the vaccine rollout, except the UK, of course. They've been the best, but so there's still potentially a lot of a lot more upside left in those guys, rather than the US necessarily, because the US has probably priced a lot of it in. Aussie retail sales next week, leading indicator of consumer spending. These things are becoming less and less important at the moment. They've been largely ignored over the last couple of releases. The RBA's basically been sticking to its story. So I think in about half an hour's time, the monetary policy statement from the RBA will come out. That'll probably give far more guidance and far more market reaction than retail sales will. But look, it's one of those things that you do have to keep your eye on, particularly for the consumer sector, consumer discretionary sector. A lot of people will be obviously holding your Harvey Normans and your Scalies, etc. Looking for sign. They're starting to price in possibly a little bit too much downside correction in those stocks, in my opinion. Basically saying that no one's going to spend any money; they're all going to spend it on travel, etc. But with the shutdown of the New Zealand bubble to New South Wales on last night, maybe that may not be the case. So these guys can surprise. These retail sales numbers probably could surprise to the upside. We had building approval numbers come out this week as well, up 20% in Australia on the back of 17.8% the previous month as well. This is the first one without the subsidy, the up 20%. So, or there may have been a half, I think, but look, very strong building numbers there. Input costs are going to probably affect us to some extent. Obviously, I discussed that lumber price before. 10:30 Wednesday will be US core CPI and headline CPI. The Fed does prefer to use PCE, which wasn't quite as high as they thought this week, but all the producer inflation numbers, the manufacturing inflation numbers, etc., were rattled out this week, and they're showing huge rises. I think there was big multinational retailers like Kimberly-Clark, Nestle, Infratel, all basically said that they were starting to pass on the rise in their input costs to consumers as of this quarter. So this might be one of the first ones really that we get to, I think it's a preliminary number where we actually get to see see if any of this pressure on the supply side actually passes through to the consumer. So that'll be fairly interesting, I would have thought. And as I mentioned before, the chatter about inflation and tapering, etc., is coming up more and more in news articles and briefings when I'm reading in the morning. So, yeah, that we're very much sticking to our view that growth sector of the market is extraordinarily vulnerable at the moment. Please be careful with that stuff. Even if you're 30% in the money, 40% of the money on some of these things, we've seen stuff like Afterpay and Appen today drop. Afterpay dropped over 10% at one stage. Appen dropped 22%. So those gains can be very quickly erased. So minimum trimming out is of some of your positions is quite a sensible thing to do in the long term. So because you just don't want to get caught in a situation where a lack of liquidity ends up giving away your hard-earned money. So yeah, that pretty much wraps it up for the Macro Minutes this week. Thanks for listening. Look, and from the trading department point of view, there's been some erratic movements. Play it safe. Conservatives not such a bad thing at the moment. Banking some money is not such a bad thing at the moment. And look and make sure you're having a look at your preferred high quality stocks, things like Macquarie Minerals, Mineral Resources, and things like that, and trying to pick a point where you might want to re-enter in the event that there is a pullback. So and also some of the index stuff and the ETFs as well. So plenty of opportunities in down markets as well as up markets. So you just got to be well prepared and stick to your trading plans or stick to your investing plans. And look, you'll find that over the long run you'll do significantly better than being overly passive in periods like this. Anyway, thank you very much for listening, and we'll chat next week.